October 19th, 1987. By the time the closing bell rang, the Dow Jones Industrial Average had fallen 508 points. Nearly 23% of the entire U.S. stock market vanished in a single trading session. On the floor, traders wept. In boardrooms across Manhattan, executives who had built entire careers on financial certainty were suddenly staring into a void. Nobody had prepared them for a collapse of this scale. Working out of a cramped office above a cotton exchange was a 29-year-old trader named Paul Tudor Jones. While the rest of Wall Street was paralyzed, Jones was calm. He was in the process of executing one of the most profitable trades in modern history. This was the result of a calculated prediction, one built on the realization that market behavior repeats itself in ways that the mainstream models of the time ignored. Earlier that year, the Dow climbed 40%. Wall Street was euphoric, believing they had entered a period of permanent growth. Jones remained skeptical. He lacked the traditional Ivy League pedigree and insider status that often bred a sense of safety among his peers. Instead, he was an economics graduate who learned the market as a runner and clerk in the high-pressure New York Cotton Exchange. In the cotton pits, he developed a theory that markets behave like weather systems, driven by repeating, cyclical patterns rather than a straight line. He used this philosophy to found his own firm, Tudor Investment Corporation, at age 26. His distance from the Manhattan establishment allowed him to question the 1987 bull market at a time when few others were looking for the exit. In the summer of 1987, Jones and his strategist, Peter Borish, set aside the current news cycle and began looking backward. They were looking for a specific ghost, the market data from 1929, the months leading up to the Great Depression. They mapped the 1987 market curve, then laid the 1929 data directly over it. The lines followed an identical parabolic path, rising on pure momentum. The overlay showed 1987 reaching the exact same mathematical cliff edge. The drop was imminent. Jones called the resemblance spooky. The data gave him the conviction that a violent correction was mathematically unavoidable. The comparison suggested that while financial technology changes, the patterns of human behavior recorded in market data stay the same. In October, that momentum finally broke, leading directly to events of Black Monday. As the broader market struggled, Jones's position proved the value of his methodology. His reliance on historical data had allowed him to navigate the collapse. The 1987 crash was a modern echo of the 1929 panic. Both events serve as a reminder that markets are ultimately a reflection of human psychology. During a bubble, the consensus of the crowd often makes it difficult to see the repeating patterns that suggest a coming shift. Financial foresight begins with the recognition that while the tools of the trade evolve, the cycles of human behavior remain fixed in the data of the past. In the summer of 1987, the Dow Jones Industrial Average was on a relentless climb. Standard traders were printing money daily as the broader market ignored gravity and continued surging toward record highs. While his colleagues on Wall Street were enjoying effortless profits, a young hedge fund manager named Paul Tudor Jones was actively bleeding money. Every week he was taking calculated positions betting that the market would fall, and every week the market kept climbing. This diagram illustrates exactly what Jones was tracking. Instead of looking at daily profits, he was focused on the geometric shape of the market. He recognized that the steady, sustainable growth trend had broken, mutating into a steep, vertical ascent, known in finance as a parabolic blow-off top. If you look at historical data models mapping these specific formations, none of them end with a gentle stabilization. The math suggests that once an asset's price goes strictly vertical, the subsequent collapse is completely violent. A severe drop was inevitable according to the numbers, but the market can stay irrational for an incredibly long time. So the question becomes, how does a trader who is stubbornly incorrect week after week, absorbing loss after loss, survive long enough to capitalize on the break? In high-stakes finance, predicting an event early is entirely useless if your cap haul dries up before it happens. Surviving the wait is the entire game. Rather than throwing massive, reckless capital into a single short position, Jones approached the climbing market the way a disciplined poker player approaches a hand with highly favorable odds. This chart visualizes a concept called asymmetric risk, and it was the core of Jones' strategy. He built his position using put options, which are essentially cheap insurance contracts. They cost him only a tiny fraction of his capital up front. but they are designed to mathematically multiply and explode in value if the underlying stock index falls. Because the market kept rising throughout the summer, those premature insurance contracts repeatedly expired completely worthless. Month after month, his fund absorbed a string of tiny, frustrating losses. Jones operated on a strict principle: play great defense, not great offense. Immediate profit was irrelevant. His entire priority was protecting the base capital he already possessed. He maintained absolute discipline over his position sizing. Every single put option he purchased was mathematically constrained to ensure that 100 consecutive losses would not knock his portfolio out of the game. He never actually attempted to predict the exact date the market would break. He was paying those small daily losses simply to purchase time, buying enough insurance to keep a seat at the table until the economic reality finally caught up with the prices. By mid-October, holding that contrarian stance was psychologically exhausting, but underneath the surface euphoria, the hard economic data was finally beginning to fracture, validating his underlying thesis. This data visualization tracks three converging metrics from the autumn of 1987. While the top-line Dow index was still climbing, the foundational supports were giving way. Domestic interest rates were steadily rising, and the value of the US dollar was weakening internationally. Adding severe pressure to these traditional indicators was a modern, unseen force: program trading. This was a relatively new, completely unregulated system where computers were allowed to automatically execute massive block trades based on algorithms. The system contained a dangerous structural flaw. The computers were programmed to blindly sell off huge volumes of assets the moment prices dipped to specific thresholds. If a minor correction triggered the first wave of selling, it would drop prices further, instantly triggering the next wave, creating a mechanical, unstoppable avalanche. Without realizing it, the financial sector had wired together a machine perfectly optimized to crash itself. It only required a single, sharp downward push to start the chain reaction. By late October, Jones and his partner Peter Borish saw the shifting data and recognized that the parabolic threshold had finally been breached. They possessed no psychic abilities, they had no idea the breaking point would arrive on a Monday, and they had no way of knowing it would become the worst single day in the exchange's history. The tension gave way. The avalanche hit. As the market opened on October 19th, the computer algorithms kicked in and seized control of the volume. The physical trading floor descended into raw panic as brokers were buried under an exponential cascade of automated sell orders. The resulting drop wiped out hundreds of billions of dollars in hours, validating Jones's mathematical models with terrifying precision. Because Jones had patiently absorbed weeks of tiny, frustrating losses, his portfolio was packed with defensive put options. As the underlying index cratered, those cheap contracts detonated in value, securing him a fortune while the rest of Wall Street burned. Mastering a chaotic, irrational system does not require you to predict the future. True mastery means engineering your risk so securely that you can comfortably survive being wrong, day after day, right up until the exact moment you are spectacularly right. By the time traders in New York poured their first cup of coffee on Monday, October 19, 1987, a massive wave of selling was already tearing through markets in Asia and Europe. The panic spread west, hitting the London exchange and confirming the contagion was completely global before the American markets even opened. When the opening bell finally rang in New York, the pressure had built to a boiling point. Sell orders flooded the floor immediately. The physical infrastructure of the market, which relied on human brokers routing paper tickets, simply could not keep up with the sheer volume of fear about to hit it. To make matters worse, Wall Street was experimenting with a new technology: program trading. These computer systems were designed to automatically sell stocks if prices dropped to a specific level. This diagram shows the fatal flaw in their system's logic. When one computer sold, it pushed the market price down. That lower price triggered another computer's automatic sell order, which pushed the price down even further. Because nobody had stress-tested these algorithms together, they created a blindingly fast, vicious cycle of automated selling. Down on the trading floor, the human brokers were helpless. As the computers hijacked the market, genuine panic set in. The volume of automated trades was so heavy that the physical ticker tape, the vital lifeline of information for everyone in the room, fell an hour or more behind the actual market. Traders were flying completely blind. They were forced to make high-stakes decisions while staring up at numbers that were completely obsolete. Black Monday was a complete mechanical failure of the financial system, driven entirely by blind algorithms. This chart captures the scale of the collapse. By the close of the trading session, the Dow Jones Industrial Average had lost 508 points. That single drop represented 22.6% of the stock market's entire value, wiped out in one day. To this day, it remains the largest one-day percentage decline in the history of the exchange, surpassing even the worst crashes of 1929. For the professionals managing the money and the public reading the evening papers, the realization was the same. Fortunes built over decades were completely gone. For almost everyone on Wall Street, October 19th was an absolute catastrophe. But in one specific office, the mood was remarkably calm. That office belonged to a trader named Paul Tudor Jones. While the rest of the market was buying into a booming rally, Jones had spent months carefully assembling a massive contrarian position, betting against the trend. Now, that trap had snapped shut exactly as he planned. Maintaining that position required incredible discipline. He had willingly bled small, consistent losses week after week, just to keep his defensive posture alive until the market broke. When it finally did, the payoff was staggering. In the month of October alone, the Tudor Fund returned 62% for its clients. That one trade compounded their success, pushing the fund to a total return of approximately 200% for the full year of 1987. Jones personally took home an estimated $100 million in profit. Following the crash, his firm's assets surged from $300 million to over $1 billion. While the blind automated feedback loop of program trading destroyed the masses, Jones harnessed the math of that exact collapse to execute one of the largest wealth transfers of the decade. The narrative that followed often painted Jones as a lucky gambler who hit the jackpot, but that ignores the reality of the trade. His actual edge was deep historical research. He studied decades of market history and recognized a distinct structural pattern that euphoric investors completely ignored. Spotting the pattern is one thing, but acting on it requires extreme psychological fortitude. He held on to a deeply pessimistic position while watching the rest of the financial world get rich in a bubble. True legendary status comes from having the conviction to spot the signals early and holding your ground while everyone else insists you are entirely wrong. Nearly 4 decades later, Paul Tudor Jones approaches the markets using those exact same principles. This diagram shows his enduring economic rule. Whenever market valuations become completely detached from actual fundamentals, gravity will eventually force them to snap violently back to Earth. The biggest opportunities in finance are rarely found by reacting to the chaos as it happens. They are found by identifying the underlying math before the chaos even begins. Wall Street's physical floors may be quieter now, replaced by servers, but the human cycle of euphoria and harsh reality remains exactly the same. Black Monday humbled almost everyone who lived through it, but for the one trader who trusted historical data over collective hysteria, it became the indestructible foundation of a financial empire.